No,
Are
we're
we good?
live.
All right.
We're good. Let's this is going to be a fun one here because
Graphs, numbers, charts.
we're going to try to take this on in
I
a way that we've never done before. We've taken obviously a lot of heat over the course of the year.
It does
No
feel like
values.
we got to the spot where we were concerned about affordability for folks sooner than what the industry did. And some of that could be, I think that being a smaller lender, we were able to feel the market changing on us maybe a little bit faster than the big companies, like we'll call it Rocket or some of the movement mortgage or guaranteed rate. We felt some of those pressures, I think, a little bit sooner than everybody else.
I remember sometime late spring where we were talking about appraisal gap going away. People wanted to argue that's never going to happen. Nope, not here, not in my market, not me. Okay, that went away. Now we've been beating the drum of, okay, as they raise interest rates, the values are going to drop. Something has to give. Nope, values, the inventory is so low, there's no way the values are ever going to drop. That was the next thing we've been fighting through. So we want to show you guys what we look at, maybe a different way to look at it. And I want you guys to visualize your particular property. Everybody's pocket or neighborhood or city they live in is a little bit different, but this is going to affect all areas. It's not a matter of if, but kind of when.
Yeah, the other, sorry to cut you off, but the other thing I think that maybe got us a little bit in tune sooner is we have the benefit of our business coming from three different areas in relatively equal, meaning that we have a big part of our business in Michigan. A big part is coming from, call it Southwest Florida, and then also a substantial chunk of our business is coming from here in the Phoenix, the Greater Valley area. So we've had a chance to see how those markets are all operating somewhat differently and the reasons for it. Sorry to cut you off, but that was the other thing that popped into my head.
Yeah, I mean, we're going to show you again, once we get to the chart here, how drastic the last, we'll call it even 3 to 4 weeks has been. And what we expect as we move forward into maybe January, February, March, as we come into the spring buying season. Nothing's going to happen over the next 2 months at the end of this year. There's nothing major other than time is going to pass and home values are going to slightly keep cooling. Which chart do you want to start on? You take the lead here, and
I think it makes sense for us to just kind of go to the overall affordability.
Okay.
And let's start there. Again, this chart says if we're going to assume a principal and interest payment of $3,000 a month, what does that mean to how much you can borrow over the course of time from January of 2021 to where we're at now? So January of 2021, you can see the corresponding interest rate, and a $3,000 principal and interest would equate to mortgage borrowing ability of $744,000. And then you can see some ups and downs with the interest rate, but what those minimal changes mean to how much somebody can borrow or their affordability. And everything was pretty calm until, that entire year of January 2021, we had some fluctuation there, but it was relatively modest, right? So over the course of a year, we saw, I'll say a meager $52,000 difference in your borrowing capacity based on interest rate fluctuations,
That's not going to stop people from refinancing. That's not going to stop people from buying. That was, it was heating up quickly. So January of this year, again, we were on a 1-year run there and felt like things were going to go forever at that pace. And that's when all the multiple offer situations, all the fear of missing out happened. Go down to that. Look at that from
So
January to April.
in
Wow.
this period of time, we had abnormally low rates. You know, we'd seen 3.25 rates 2 to 3 times in prior cycles. So when we got below that 3.25, that was abnormal. So it heightened sensitivity. We had folks that were working from home that maybe they could relocate from their area. And then we also had that surge or that niche of Airbnb properties or short-term rentals that became a rage. So all of that stuff increased demand more so than normal. Then we get to April, and that 1.5% increase, it literally turned the valve off on refinance transactions. Very few people would refinance for lower rates. When rates jumped that much, if they were looking to pull cash out, home equity lines of credit became a better alternative than did a traditional first mortgage.
Yep.
And then that also started to impact. That was when you put out that post that appraisal guarantees or appraisal waivers on a real estate contract should stop or did stop. We just don't, the greater population just doesn't know it yet.
Yep. So as those refis started drying up around April, this is when you start seeing the layoffs industry wide. And this is when operationally each mortgage company had to start to shed payroll.
And the emphasis of niche products. Every lender came in now and said, whether you call it the bank statement loans or the DSCR for purchasing investment properties, where you can use alternative qualifications, every lender decided they now wanted to do that, where that was a total niche product prior to that period of time. When I say niche, there were a handful of lenders out there doing it, but it became the rage and all lenders jumped into that space.
All right. So after we jump up 1.5 from January to April, then we move back out another 3 months. We're up and over another 0.5 point. Now we're 200,000 plus in affordability from where we were, 15 months earlier.
And I know a lot of realtors out there, their defense mechanism, or they wanted to convey to say, hey, again, 5.3 or even 6.6, historically, that's not the end of the world. But my God, when you look at that affordability difference or borrowing power, that's the part that I think a lot of folks didn't acknowledge, that increment of that change.
Until really about a month ago.
Yes. And that's when we got to.
Here we go. We're 7%.
We're flirting with 7%. It's been priceless to see some of the economists that we follow in the housing sector, and nobody expected rates to go this high. But now they reflect back and they say, okay, the difference in mortgage rates from 4 to 5%, it didn't have a sizable impact on slowing down demand. Once it exceeded 5%, that's when the brakes were put on buyers' enthusiasm about buying.
Okay, so
cash buyers don't care, right?
Nope.
Cash buyers are kind of excited because maybe home values are coming down or slowed down. So still a good opportunity for them.
So what this doesn't show is what home values are doing. We're going to move to that chart here in a moment. Anybody that wants this chart, obviously just drop us a message. We'll get this off to you guys. But what we want to do next is show you how the home value portion of this correlates to the interest rate and what it does for affordability.
And we're going to pick on Arizona a little bit here because this market's kind of they're first in and they're first out on all of that. So this is just kind of a snapshot of a property that we followed out here in Arizona. I'm going to say it's kind of a super common demographic of a home, meaning it's a newer home, just under 3,000 square feet, 4 bedrooms, 3 baths with a pool. It's a family home. It's what a lot of people would be looking for if they have a family.
It's a tract home built in the community.
You got it.
Other similar properties. It's stamp them out, right?
Yep.
Okay.
Built by Lennar, one of the nation's largest builders. Community's got 14, 15, 1,600 homes in the community. So it's a pretty good snapshot of, the east part of the valley.
Okay. Will you slide that up a little bit? There we go. Yep. Perfect.
There we go.
Okay. So this home peaked out on June 8th of 2022. This is Zillow that you're using, correct? Zillow values?
Yeah. Mm-hmm.
Okay. Everybody can go to Zillow. They've seen it, this estimate. Well, that's what we're using to track the value of this property for this particular exercise. So when it peaked out in June, interest rates were 5.23. That's a principal and interest payment.
It is.
Of 75% of that value, 4135. Okay, so a month later in July, not doing much, not moving down, interest rates up slightly. Really, though, then we get into August. Now we're at a 5% correction. Interest rates are still hanging in the 5s, 5.3.
But again, we're above that 5% number, so it's starting to erode on a purchaser's desire or ability, maybe, to be as excited about the property values and the demand or the desire to purchase.
All right, late August, it drops even more. Interest rates are starting to climb. Mid-September, again, this is only 45 days ago. Look at that. Now we're down 11%. Interest rates peak over 6. Here we are today. It's down almost 13%. We're over 7%. And look at the payment there.
Yeah, amazing.
And everything is just stalled at this point.
So one of the challenges that we're having of not getting more inventory, if you take this buyer as an example, when they purchased the property, they've got a $2,300 principal and interest payment. If they're to move and jump back into the market, look at that payment. It's almost doubled on that prospective seller if they need to move and do something different. So that's the part that's
well, most are going to move up, right?
Yes.
I mean, in that territory, you're a move up buyer. Well, now you have to go even higher than the 872.
So even if you're moving up, or let's say instead of a 2-story, you want to get a 1-story because it's a quality of life, but you're not going to be able to reduce your purchase price much because you're looking for a home that maybe has more specific amenities to what you desire. That bottom line there, this is just, if you can follow along for a second, we threw in a hypothetical interest rate of where we may get to at some point next year. But if we go over here and just say, look at, if it was exceeds a normal appreciation rate over 3 years. If we said 6% appreciation over 3 years, historically, that's really solid. the value of that home should be in the 733 range. And we're
I'm with
still
you.
still $140,000 over what a normal market may yield for this particular homeowner. You know, if we let's jack it up to 8% per year, which is incredible, there's still $100,000 of property value to get to a more normalized market. And then you can see obviously what that does to the payment. That would get somebody much more excited.
So what we believe between 1027 and the TBD is we're going to see, as interest rates remain around 7%, which we believe they're going to remain there for a bit. Fed's going to raise rates in November. Fed's going to raise rates in December. We're not sure what Fed's going to do after that. But what we believe will happen is home price continue to erode a bit. Don't have enough qualified candidates to purchase, or we don't have enough people incentivized to sell.
Yep.
And then we will start to slowly see some easing of those rates. So to get to that TBD number, the question is, how long does it take us to get there? Is it 3 months? Is it 6 months? Is it 12 months? Is it 18 months? We do believe we're going to get back to that spot. We just don't know when. But the main part about this chart is to remind folks that home values are beginning to drop. It doesn't mean it's happened in your particular community or your house today, but it's going to happen.
Yes. Again, I just go back to this. Even if we said 10% appreciation for the last 3 years, instead of being 870, it should be closer to 820. And historically, 10% would be a phenomenal number.
Yeah.
I mean, I remember reading that, 4%, if you looked over the last 30 years, is a number that's even strong.
Okay. So
not saying a crash, but there just has to, the pendulum, right? The pendulum went way too far to the extreme of values jumping and demand. Now we're back to the other way, which if we show this other graph, your favorite term here, what's going on right now? Crickets. And if you talk to mortgage lenders and or the real estate community, that's what it feels like right now.
So 2 years, it's off $300,000 in purchasing power. That's a big number, astronomical number. So cash buyers are sitting, waiting, watching those values come down. People buying investment properties have stopped because the rate of return that they're going to receive on their particular unit.
Investment property purchase rates.
Yeah.
Instead of 7, you're looking at something that's going to be north of 8. So
correct.
The rate of return,
that's done.
The cash flow up. Yeah, it's just frozen its tracks.
So this is just this is what we see from the markets that we serve. If you need us to help plug in some numbers for your particular property, we're happy to do that to make more sense of it. But awesome stuff today. I hope that helps.
You said
somebody.
That you said this earlier on TikTok, but those of you out there that might be looking at this that are homeowners, it is our public service announcement is consider getting, if not getting, a home equity line of credit. It's a good time to consider it for 2 reasons. It's always easier to borrow money when you don't need it. And the second part is property values right now for an appraisal purpose may be higher than what we're going to see moving forward. And again, the third reason is you don't need to pay interest on a home equity line of credit if it sits there with a zero balance. So consider doing that.
And no closing costs typically.
There you go.
All right. Great stuff today. Ken, thank you.
Good job, bud.
Talk soon.
See ya.